Hey, welcome, students. I have Carissa here, Darren, Kenny, as usual, my three students, online students here. Um, I'm sharing my screen here. Today is the deadline to submit your midterm project. However, I gave some grace period. Today I announced your deadline for your project is Friday, 12 p.m. That's the drop dead deadline that I cannot change. But having said that, the other thing I wanted to tell is the deadline. So by all means, you submit by Friday. So as I said, I want to repeat again. 35% of, I'm sorry, 25% of your grades come from all the quizzes I'm going to give within the semester. 35% come from this midterm project, and rest of the 40% comes from the final project. Okay, Carissa, we have a question.
Yes, sir. I noticed that for our presentation assignment, you put it for 11:59 p.m., which would be a minute before midnight.
Yeah, it's like I'll change it. So Friday. So today deadline I pushed it to Friday. So Friday afternoon. So 11:59 a.m. I guess.
Okay.
Yeah.
Okay.
By afternoon, I have to have it. And I extended the grace period, supposed to be today. And also in the assignment section, I created a section in the assignment section by all your presentations needs to be uploaded here in this midterm project. And the and this the examples for this is in the corporate presentations. These are the ones I told many times. Some students they have not watching the videos, class instructions. We thought that it's going to be nightmare. As I said, this is the final notice to all of you guys. Please submit your project. Has 35%, one third of the weight comes from this midterm project. If you miss the deadline, you definitely are going to fail. And so there is no more grace period. This is extremely important. Please pay attention.
Understood.
Carissa.
And then this presentation, this is for just like the income statement and the balance sheet. We're going to get to like the cash flows and everything in a second presentation.
That's the final presentation. Yeah, that's the
Okay.
thing.
Okay.
I want to put the relative valuation, and I think if you watched my other videos, I gave clear instructions on that part. What
I was
is
just
it?
clarifying. I've been
Yeah,
here for
yeah,
about.
no, that's good. That's good to ask. And what I meant is, so this is a recorded line. If somebody is watching, that's the thing.
Understood.
Yeah. So we need to get the clear cut instructions I was given, but I'm going to put one maybe more high level, like a Rubik's in the assignment module, so that you can expect what I was looking for again to reinstate, to reiterate the things. Yeah,
Perfect.
that's good. So bottom line is we talked about the, I'm just repeating again the things. Now we set up the portfolio. Those who have portfolio and I'm watching going to give grades based on how your portfolio is performing. And we worked on the cash flow analysis, like rates, returns, time value money, and calculating the cash flows, net present values, IRRs, and all that. And then you also looked into the industry and competitive analysis, looked into the what company your specific company, what industry it is, and how the relatively your company is performing. And I also asked you to collect the data from your annual statements and quarterly statements, and also asked you to review your quarterly meeting analysis. And then we went to the financial statement analysis. Basically, we talked about the income statement and also talked about the balance sheet analysis and high level at the cash flow, but talked about the ratio analysis and the relative valuation. So your project, midterm project must have income statement analysis, balance sheet analysis, and ratio analysis. And I would be really impressed if you can put the relative valuation. So that means if your company's price to earnings versus the industry, other competitors' price to earnings, price to book compared with others, price to cash flow compared to others, and cash conversion cycles compared to competitors. If you put that, you get the additional benefits of the project. So that's the thing. And then we talked about the dividend discount models. I talked about the plain vanilla dividend discount model. And I also gave you the complex model, like H model. Have you guys watched the video H model and the two, three-step models? So because you're already here, four of you, five of you, yeah, has anybody watched that DDM, dividend discount models videos?
I have not yet.
Yeah, you should watch. And I'm going to give the assignments, so that's what you got to be careful. I think, how about Sylvia? Have you watched and get a chance to watch?
Excuse me. I've watched the first one, but I haven't watched the advanced model.
Yeah, please go ahead and watch. And I'm going to give you a quiz. But the reason I did not give the quiz for the this week is I guess you guys are all working on the midterm project. As I said, midterm CAT is 35% of your weight. So please work on it. Otherwise, you don't get the good grades. Go, Carissa.
We going to be receiving any grades on a few of the assignments that we have?
Yeah, I will be. I mean, I'll be giving it to you. I'm waiting for this project to be done because it carries one third. The all quizzes combined gets you one fourth, 25% of that, and 40% is the final project. Yes. But this carries heavy weight, one third of the project, one third of your grade. Got it, Carissa?
Yeah, so we'll be able to at least see where we're standing
Yeah,
before.
yeah, yeah, yeah. I will get you that. Let's see, here is the thing. You see the Excel spreadsheet, and I'm going to put it 18. So all quizzes, I'm going to publish this one. All quizzes, you get 25%. Um, so, so, so what you have done is like maybe 12% or 14% of your total grade. So don't sweat too much. That's midterm project is 35%, and final project is 40%. Does it add to 100%? Am I right? 100%, right? And the bonus is attendance to live classes. And then was the class engagement. These are additional things I consider. If you are something lagging here, it may add some bonus here. So that's the thing. So, I mean, this doesn't carry any value unless you have some value here, unless you have good thing. If you are in the borderline, these can push you up a little bit. So that's what I meant to say. So those people who cannot attend, I understand you don't miss anything. You're not penalized for not attending the class because it's a asynchronous class. But if you have time to attend, if you time to engage, if you time to talk to me, if you can't reach out to me during the class, you can talk to me offline. You can email me or you can connect with me. That's the only way I get to know who you are, what you are doing, and all that kind of stuff. Otherwise, it doesn't serve the purpose. So that's the thing. So with that said, I'm going to actually I need to put this one, save this one. Bear with me. Guidelines. So here is the thing. Let me go back to the class. So let's hang on to the administrative questions at the end of the class. Then we can go from there. Can you guys see my screen clearly visible? Is it clearly visible?
It could be a little bit bigger.
Okay, that's what exactly want to know. Uh, oh, this is like this. Because this my monitor is too big, so sometimes it's hard to see. Can you see now better?
Yes.
Okay. Now, actually, see in the module 7, I created the free cash flow analysis. This is extremely important. I'm going to give you, it's like in a spoon feeding class. This one is extremely useful, and I'm going to put the numbers in my Excel spreadsheet. By all means, you can use this as an example, and you can do free cash flow analysis on your company. And then also we wanted to do the free cash flow modeling, how you can do that. It's like a free cash flow analysis for your company. And then we go some math, and I want you to project your company's future cash flow and come up with the free cash flow model pricing. So you have in the final project, you're going to have valuation based on the relative analysis, like based on the price to earnings, price to book, price to cash flow, versus compared to the industry. If your price to cash flow is 15, if the industry is 22, and based on the price to 22, the valuation is $200 because your stock is trading at 15, around like $160. You can say you're relatively undervalued based on the relative valuation purpose. And then based on the dividend discount model, and if they come up with the price, the valuation, and compare with the price to earnings and with the industry, you can say it's overvalued, undervalued. Same thing with the free cash flow model. I'm going to cover that. But before we do jump in, I want you to look into this. This is the material free cash flow analysis. It's easy to understand material. I uploaded for you guys. This is the core material I want you to use. This is kind of slow. Uh-huh. And this is the material I gave it to you guys. So here, this is the material I created PowerPoints based on this. So it's easy to understand, easy peasy. All you need to do is just read the material, and I am going to cover how these formulas work. Once you watch my video, you think, oh, these look very complex, but the way you explain, yeah, I can easily understand. I can easily run through this. So first of all, we need to calculate the free cash flow model. So this is the material I want you to download, and please practice this model, how it is calculated. This is the industry standard. When you go out, you need to do the free cash flow analysis. You can do by all means. And also the PowerPoint presentation I'm going to present, it's already here. I also uploaded that one, that you can use it for your reference. Okay. So with that, I'm going to present my case here, how to calculate the free cash flow models. So can you see now it's better because the screen is bigger?
Perfect.
Okay, wonderful. This is exactly what I want to hear. So free cash flow analysis. So we talked about the net income and income statement analysis. We also talked about the balance sheet. Income statement has nothing but the revenue, and then you have the expenses, and beyond that you have the interest expense and the tax expense. Anything before interest and tax that we call EBIT, earnings before interest and tax. And after earnings before interest tax, then you take out the interest off. That is called EBT. In the EBIT, all you're taking is I is out. Then you have what? If you subtracted interest portion, that is in earnings before taxes. That means once you pay the taxes, then you get the net income. That's all. That's the net income statement. In the balance sheet, what you have is the amount of cash, and then you have the account, and then account receivables and inventory. That is the current assets. Underneath that, then you have the long-term assets, and then you add it together. That is total assets, right? And the liabilities portion, all you have is what is your current liabilities, that is short-term debt payment, and then you have the accounts payables, that is current liabilities. Under that you have the short-term debt and the long-term debt, and then that's all together you get the total liabilities or total debt, total liabilities. So current total assets minus total liabilities, you get the equity. That's it. That is a balance sheet. And then you come to the cash flow. Cash flow has a operating cash flow. Operating cash flow is nothing but net income. Then you add the depreciation or the non-cash assets, what they call NCC. Then then you subtract or add the changes in the working capital. Then then you add it together. Then you get it the operating cash flow. And from there, you take out the capex portion of the investment cash flow, that it gives you free cash flow to the firm. So then there is a free cash flow to the firm and free cash flow to the equity. So free cash for the firm means a firm is owned by two people, right? One equity holders, people like you and I who are the shareholders, and the debt holders, because companies borrow. So the company is not totally owned by the shareholders. Company is also owned by the debt owners. So anything cash coming that could be shared, distributed between equity holders and the debt holders, because debt holders can demand more than what they get. Bottom line is they get the interest payment, and finally the whatever the amount they paid. So free cash flow for firm is basically, when you are saying to the free cash flow of the firm, means that amount reached to the total capital investors. So then from there, you do make some adjustments. Then you get into the free cash flow for the equity holders. Basically, you adjust the interest portion, and then whatever the net borrowings. That's all. Here is the graphical picture. When we sell the products and all that, we get the cash, right? And the cash reserves, what we spend is, one is a working capital investments. That means you buy inventory, you pay the account receivables, you collect the account receivables and pay the account payables. Working capital is nothing but only three things, three components. One is account receivables, and another is account payables, and third one is inventory. So that is the working capital, right? Then fixed capital investments. So after the cash you there, then what you do is, then you need to invest into the whatever the leftovers to the capital investments. Otherwise, company don't run, right? You need to build the factories, you need to replace the machinery. That is the fixed capital investments. So whatever the leftover is operating cash, operating expense, and yeah, when you take out that, then it moves into free cash flow to the firm. So yeah, you got to pay the taxes. That's the tax portion. Then whatever the leftover is, this free cash flow for the firm. And
I have
from
a
there,
quick
okay,
question, Professor.
yeah, accounting guy, go ahead.
If you were to see low operating cash and very high financing, would you see that as a negative sign, or maybe just a company that needs to raise money?
Uh, Say again, the company is what?
So like if you notice on their balance sheet that their operating cash is very low,
Uh-huh.
but their financing activity is raising higher and higher, would you see that as like a sign that they're, I guess, not operationally strong?
Again, it depends. Yeah, yes, and yeah, you're right. Yeah, if the company is like the so-called cash burn rate, if the cash is going depleting, that means you're burning more cash and you borrowing more cash. That's a different observation. Yeah, that is true. But it's had nothing to do with here. But actually, you're correct. You're correct. But that's what you call cash burn rate. If you are burning so much cash, so you got to build some cash reserves. So after all spending, you need to have that free cash flow to the firm, and free cash flow to the equity holders. That has to be high. Otherwise, it's a cash burn rate. The company is going into the bankruptcies. That's the way they go, because they're burning more. That's what the Spirit Airways gone through. They are burning, burning, burning. Actually, if you are an investor, if the cash burn rate is high, if they're not generating enough cash, that's companies into trouble. Yeah, good point. So we can cover that point also later. That's a great observation. So free cash flow for firm, how you calculate is, so simply, so this is free cash flow for firm is net income, and then add non-cash charges. Is nothing but non-cash charges are depreciation. So simply add depreciation, and then add interest portion of it, because free cash flow per firm is for both equity holders and bond holders, right? So you add the interest portion, then subtract the changes in the working capital and our investments in the working capital, and then subtract invest in fixed working capital or fixed capital investments. If you subtract those two, simply you get the free cash flow for firm. That's it. And then here is the to get the free cash flow from equity. All you need to do is Uh, then you got the add the net borrowings for the free cash flow for firm, and then you take out the dividends. That is what you get it for free cash flow for equity. So whatever is the free cash flow for firm, then you need to add the borrowings and then give away the dividends. That's to subtract the dividends. That is what you get. Free cash flow from the other side. Um, this is exactly what we got. What I explained is in the graphically. Here is the formula for calculating the free cash flow firm. So it looks overwhelming, but I'll tell you how to nail it. It's super simple. I'll explain it to you. So free cash flow for firm. So as I said, net income plus depreciation minus subtract the working capital and subtract the fixed investments. Or you can call the top portion net income plus working depreciation minus working capital changes. That is called cash flow from operations. And if you subtract from the fixed expenses, that's called free cash flow for firm. But realistically, it's not 100%, but free cash flow for firm also, we shouldn't ignore the interest portion because firm free cash flow for firm is both bondholders and stockholders. So that's why you add the interest portion back. That is more pure form of free cash flow for firm. That's the only thing is adding back the interest portion. And if you wanted to do the free cash flow for firm, there is another way of doing is without doing all the interest portion. You take the EBIT, earnings before interest and tax in the income statement, then basically times by 1 minus T, then add the depreciation portion, just like a, and then this is on the top portion, whatever you have, this is similar to this. Rather than doing all this, all you need to do is EBIT times 1 minus T and plus depreciation and minus fixed cap, minus working cap. That's it. That gives you free cash flow form. That's so easy to do that portion. So when I show you the income statement, I show the balance sheet, and we'll work on it, then you can understand easily. Instead of EBIT, if you take the EBITDA, the formula is EBITDA times 1 minus T, because you need to get out of the depreciation, just add the depreciation time T, and then subtract this working capital. And so by doing all these, you get the same numbers. Or you can say the free cash flow for firm, CFO minus fixed cap, but add the interest portion. That's it. Then you get the free cash flow from. So the formulas looks overwhelming, but it's not that expensive, not that complex. But when you come to the free cash flow to the equity, all you need to do is free cash flow for firm minus subtract the interest portion, but add the net borrowings. Then it gives you free cash flow for earnings, for equity. So let's do some math here. And I do the math, and let's do here is the math, whatever I explained. And let me copy this and do it in Excel spreadsheet. That way you can understand very well. So I just copy these. Hopefully I can copy the example. The sheet I created from here. Uh, nope. So let's go here. Can you see my screen? Let me make it big. No.
Zoom in on your, like, keep the window open like that, but zoom in on the Excel sheet. Perfect. I mean, not that far, but you get it.
No more spreadsheets, Professor. I look at these all day in accounting.
Yeah, I know. Unfortunately, not all students are. Uh, so this is the income statement. Let me go back here so that I know this is a uh, sales. I don't need the cost of goods sold. So yeah. Actually, just I wanted to, yeah, this is 2007 and 2006. Let's say 2025, 2024. I guess let's go here. And sales here 300, 250. And I'm skipping some of them. I don't need all these. I'm going to depreciation. So this is if you take out the cost of goods sold, you get 180 gross profit and sales and goods 35, depreciation 50. So simply uh, I'm because I'm filling whatever is needed, okay? So because I don't have time to do all this for you guys. So I see you get an idea. That's what I'm trying to get that. EBIT here, what, 95, 80? That is earnings before interest and tax. How much was that? 95 and 80. So if you see this math, it's how simple it is. It looks complex, but it's very simple. Interest is 15 and 10. So end of the day, you'll be easily pre-tax 80, and the pre-tax is yeah, 19 minus 95 minus 15 is what, 80. So that's what it is. So pre-tax equals to 95 minus 15, right? 80. This is a 70. This is what it is, 80, 70. And tax rate is 30%. Tax is 30%. So it's eight, so 30 means 8 sevens are 56. No, tax is 34, 30% pre-tax. Yeah, he calculated 30. Tax 24. Okay. That's what it is. That's 21. So 7 times 3, 21. So this is the net income. So this is income statement. That's it. 80 minus 64, 56. This is 49, right? So this is the income statement, what he gave here. Yeah. And then, boy, oh boy, it's not that this is income statement. Let me put it in a different color coding so that way it's easy to see you guys. So this is ooh, too dark. Yeah. So this is the income statement. Let's go to balance sheet. So balance sheet is 2025, 2024. So now I go to this called balance sheet. So cash, account receivable, inventory. So cash, account receivables, inventory, and what else you have? Um, property, plant, equipment. Okay, I call PPE. So gross. Oh yeah, it's called gross. Otherwise, it's so any balance sheet you see, it should be like this: net PPE. So after depreciation, accumulated. Oh, it's accumulated depreciation. So accumulated depreciation, whatever the is this minus this is a net assets, right? So total assets. We give the total assets. So let's go here. 10, 5, and 30, 15, and 80, 50. So gross PPE, this is the total assets like plants and equipment and all that is $400 and $300. But however, they carry the depreciation. Every year they get depreciated, right? So the depreciation is negative 190, and this is what negative 140. So they depreciated. So the total property value is 210. The book value, it carries as 400, but the depreciation accumulated is 190. So the total value of the net property is 210 on the book, right? When you add all together, that is the total assets. The total assets are 330, 290. Okay, 80. So yeah. Oh, current assets 30, 40, 80. 80 plus 210, 290. How come I got? Oh, I added. Okay, then inventory. I was wrong. 40 and 30. Yeah, that's the thing. That's the reason. See, now it adds 290, right? Yeah, 290 and it should be 210. There you go. So this is the total assets. Now, income statement, as I said, your cash flow statement is a combination of both income statement and balance sheet. So what you have in the liability side is account receivables, account payables, sorry, short-term debt, AP, short-term debt, then long-term debt, and common stock retained earnings. And then we have the total liabilities and assets, total liabilities and equity. So here account payables. So assets minus liabilities, equity. Equity can be broken down into common stock and retained earnings. Am I correct? The accounting guy?
Can you repeat the question? I'm sorry.
Assets minus liabilities, equity, right?
Assets, assets equals liabilities plus owner's equity.
Yeah, I mean the other way around. Assets minus liabilities, equity, right?
Yeah, true.
Okay. Accounts receivables here, 2020. Short-term debt is 2010. And the long-term debt is 114 and 100. Okay, what I meant is assets is what? 290. What are total liabilities here? 154. So assets minus liability is 290 minus 154, right? So that is comes like how much? 100 and 136. Am I correct? So
Yes.
okay, that means this they broken down 50 plus 86. Common stock is 50, retained earnings 86. So 86 plus 30 is 156. Am I correct?
That's correct.
So
Right.
yeah. So your assets plus equity plus liability is totally equals to this plus this plus this. That is common 444. No, assets minus liabilities equity. Okay. So yeah, equity is 136 plus your assets is 290, right? So 290 plus 136 is what? 300 and 290 you got? Oh, what's that? 290. Oh yeah, equity plus that, yeah, you're right. Equity plus liabilities equals to 290 total assets. Yeah, I got it. We got it. Okay, I don't want to confuse you. 50, 30, 210. Okay, so this is the income statement and standard as income statement and balance sheet. Based on that, let's calculate using this formula. Using this formula, net income plus working capital minus what is the working capital? Yeah, this is we need to calculate the working capital. We need to calculate the fixed capital. So working capital, let's go one step at a time. So what I have shown you is nothing but What I have shown you is nothing but um, the income statement and balance sheet. Now, let me calculate the yeah, bear with me one. Now let's calculate working capital investments. So working capital equals to account. What it is account receivables plus inventory minus account payables. As simple as it is. Account receivables, inventory minus accounts payables, right? Uh, anything parenthesis means negative. If I put negative, it didn't like it, so that's why I put it. Excel, it doesn't like it. So maybe it's good to be like this, maybe. So what is my 2025 working capital? Help me here. What is account receivables here? If nobody, I'll pick it. I'll pick somebody. Sylvia, what is my account receivables in 2025?
Sorry, trying to mute it. For 2025, 30.
The account receivables 30. Yeah. What is the inventory?
Inventory is 40.
Good.
And accounts payable
mhm,
is 20.
20, right? So you add together, how much we got? 50? Am I correct?
Yes.
What?
Yes.
Looks correct.
No, there you go. You got it. What's the working capital in 2024?
15.
15 plus
30,
30 minus.
20.
Yes. So what is the working capital in 2024?
25.
I'm sorry?
Oh
25.
yeah, 25. Yeah, yeah.
So my change, all we need to do is we need to change the delta, change in working capital, right? Change in working capital equals to how much? You tell me. How much it changed from 24 to 25? 50?
25.
No, yeah, 50 minus 25. 25. Am I correct? See,
Right.
you already calculated change in the working capital. See how easy it is? Now let's go for the fixed capital investments. Fixed capital investments is your total PPE. So that is gross PPE and gross PPE minus accumulated depreciation. The PPE depreciated. PPE, how much you depreciated, right? The actual gross per PPE is what? 400, but you already depreciated how much? 190, right? So what is your net PPE? All we care for net, right? What is your net PPE? Come on, tell me. This minus this, right?
210.
210. You got it. You got it. You're smart. And let's see for 2024, what is your gross PPE? 300? How much your cumulative depreciation last year?
140.
Come on, it's simple. So what is your net PPE here?
160.
160, right? So what is the change in the fixed income?
50.
Who said that 50? You're right. This is so once you know this, the formula is so simple. Now you know the values. Now let's plug and chug. So now the free cash flow for firm is net income plus net cash charges, which is nothing but depreciation, plus interest times 1 minus T, right? Minus fixed capital investments minus working capital investments. See, the formula looks so complex. Now let's go for it. Add the net income. Let's do this one by one at a time. Net income. NCC. Interest times 1 minus T. I am not good at typing, I guess. Here, interest times 1 minus T, fixed capital investments, and working capital investments. Bingo. So what is my net income? Somebody. What is-
56.
There you go. Who was it? Sylvia?
Me.
Okay, me is Sylvia. I can't see your big face. What is your depreciation? Net non-cash charge is nothing but depreciation. What is the depreciation? Sylvia, I think you're answering so good.
The net depreciation or just the
Yeah,
accumulated?
no, forget about this. We are talking about the depreciation exit, not the property. The depreciation here, you see
Oh,
this?
it's 50. Sorry.
Okay, good. What is my interest amount?
15?
There you go. But we have 15 times 1 minus T, right? So
Oh,
let's
right.
do like a 15. Yeah, you're right. You're right. 15 times, I'm doing the same math. 1 minus, what is T? Taxes, how much is that? 30%, right?
Mhm.
Yeah.
Can I put
Right.
0.3?
Yes.
So that gives me a 10.5, right?
Mhm.
Then what is my fixed capital investment? How much is it? The power plant investments. How much we invested more from this to here to this year? 50, right?
Mhm.
You see this FCC? Am I
Right.
correct?
Mhm.
Yes or no? Nobody's talking.
Yes,
Thinking.
yes, that's right. That's right.
Okay, there you go. What is my working capital change?
25.
25.
25. There you go. You got it. Now, all we need to do is add in net income and this, and then you add, and then we need to subtract this amount, right? So let's do negative and negative 50 and this is negative, right? We need to subtract this, so negative 25. So we add together, how much you got? 41.5.
That's what I got.
Yeah. Yeah, I think I made a mistake. Not a mistake. We did this good. Um, this actually net PPE. So this is the 50. Yeah. Actually, this is my mistake. I did this. So change in the working capital is this is what you need to do. Change in the working capital uh, is we need to add a depreciation to this one. So we need to change in the this one, but you need to add the depreciation 50%. So we need to do uh, FC inventory equals to end net PPE minus begin net PPE, and then you plus add the depreciation, and that is the so that is the formula. So this minus this is 50, but we also need to add the depreciation. So with that, so what is the end depreciation? 210 minus 160. That is what we did before, but we need to add the depreciation portion. What is the depreciation? How much we depreciated? 50, right? So that is the fixed investments. Change in the fixed investments is ending PPE minus beginning PPE plus depreciation. So that is the so we 210 minus 160 plus 50. So that is that depreciation. With that, what happens is this is negative 100 instead of negative 100. Negative 100. So that gives you negative 8.5. So free cash flow for firm is negative value. You see that? Is it good? Is it confusing? You guys can understand now? Can it?
Pretty straightforward. So
It's
not
digestible.
bad.
Okay, Carissa.
It's digestible.
No, come on. Digestible. What do you mean digestible?
It's pretty simple.
Yeah. So I want you to understand, account receivables plus inventory minus account payables is working capital. That's it. Change in working capital is from last year to this year. That's it. And change in the fixed investments is the net PPE. What you net PPE is in minus gross minus depreciation is the plant depreciation is like whatever the 210 here it's got 160. So 210 minus 160, and then you need to add the depreciation, current year depreciation. So not only this, but you also add the depreciation from the current year. So you add it together, that gives you $100. So when you subtract here net income, you add to the cash, net cash, that's like then you add the depreciation portion, and then add the interest minus one times 1 minus t. Then you subtract fixed cap investment and subtract working capital investment. Then it gives you free cash flow for farm. So
I have a
that is the thing.
question.
Yes, please.
Like now it's straightforward with everything with the formulas, but when you got the first number where it was 41, you like knew right away. Is it like usually in a smaller range, like in a like to 10, or it could be a 40?
Which 141? Can you?
Like the future cash flow, like your final, originally we had the wrong answer and you were able to tell, we went back.
Mhm.
Was that like a really big range or is it normally like a smaller range? Does that make sense? Like, some ratios, they're going to be 1.5. If you get 50, that's not correct.
Yeah, I mean the math is wrong here. I forgot the depreciation portion, adding the depreciation portion. The
Oh
depreciation.
yeah, I just was wondering if like the future cash flows, like, is it normally like a smaller range, like 8.5, or it could have been like, let's say the math was right and it came out to 40. I didn't know if 40 was an indicator that, oh, it's too big, we got to recheck our work, if that makes sense.
Oh, not really, but you can, at the high level, you can guesstimate free cash flow for operating. Yeah, I mean, if you are not doing any math, simply, you can say, uh, when you see the cash flow statement, here I don't have the cash flow statement. When you see the cash flow statement, if you don't do any big math, you can say net income plus depreciation, add together and subtract the fixed cap. That gives you rough ballpark number, but it's not always accurate. You understand?
Yes, I just meant like I understand what you're saying. I just didn't know if like there's a usually the future cash flow is like a smaller range where if I got a big number that was indicator I did it wrong. But I understand what
No,
you're
no,
saying.
no, but
If I fit it in,
yeah, it's hard to say. That's
yeah, like
extreme.
some ratios, if you it's supposed to be like 1.5 to 2, and if I got like 20, I know it's wrong. Like I need to redo my math. But
It's
that's all I
not
was just
the
wondering if
yeah,
that was like a
it's not the
indicator or
ratios.
something.
Yeah, it's not the ratios, but it's
Okay.
yeah, that's what you got
It's
to be careful. But if you're
got
doing for the free cash flow firm, let's say in the example, I'll tell you. It's just to give an idea. This is a real life examples I'm going to give. This my website is so slow. How come? How is going slow today? Okay, let's say if I go here, um, if I go to the free cash, just in the real life example, if I go to cash flow, and this is my net income. Uh, so if I come here, see this is my net income, 8 billion, and I add the depreciation, this is like a 10.4, right? And I subtract this 5.4. My cash flow could be approximately 6 billion. You know what I mean?
oh
8
yeah.
the 10.4 minus 5.4, so roughly 5 billion. It's not always true, but if you go to the free cash flow for firm, yeah, roughly here it came around 7.8. And of course, there is working capital change and all that kind of thing. It should
Okay.
be approximately, that's not always the proxy, but it could be that kind of thing. But working capital changes and all that, that could. So if I go to Apple and if I go here, cash flow statement. And if I go here, my net income is 100 billion and the depreciation 11. So 110 billion minus 12, roughly 100 billion. That's my free cash flow. Okay. That is approximation. But if I go from free cash flow here, see close to 96 billion. I expect
Okay.
that's kind of gives you ballpark numbers. If it is not matching, then that means you're doing something wrong.
Okay. Thank you. Thank you for showing me that.
Yeah. So this is all real practical examples I'm talking about. If you do this math, and this is not that complex. The formulas look so ugly, googly, but for us, we know how to handle those kind of things, right?
Yes.
And now I'll go to the free cash flow for equity. So rest of the formulas I let you do on your own. So because I gave you, I mean, I can't spoon feed too much, right? So, so free cash flow for firm. And let me do this math is free cash flow for firm minus interest portion. And you need to subtract always 1 minus t. And then you need to add net borrowings. That is how much we borrowed that belongs to the equity holders. So free cash flow for firm, we already know. So interest times 1 minus T, you know that part. And net borrowings, only thing I need to calculate is net borrowings. Okay, I put it here so that you understand. Net borrowing is nothing but the change in the debt. The debt here, this short-term debt for long-term debt. Here, the short-term plus long-term debt. This plus this what? 134, 110. So how much is change? Carissa, if nobody answered, I'll ask Carissa.
24.
There you go. Who answered? Carissa? No, Sylvia.
Me.
I know. I asked for Carissa. That's okay. You're good.
Oh, so
Hey,
sorry.
that's all right. So 2025, 2024. Okay, Carissa, I'm not putting you on the spot, just because I know you. That's what I'm asking. Darren, what is the net borrowing in 2025?
Net borrowing.
I just told you.
I know I'm multitasking right now. Um,
Nothing but add all the debt. What debt you have in the 2025?
114 for long term and 20 for short term,
Yeah,
so
yeah.
134.
There you go. There you go. What is 2024? It's so simple. Come on.
110.
Yeah, 10 plus 100. Did you get it, Carissa?
Yes, 110.
Okay. So what is my net borrowing? What is net borrowing from how much change from last year to now? How much we borrowed more?
24.
There you go. 134 minus 110. 24. Is it tough? Come on, tell me.
No.
So now free cash flow for equity. The formulas looks scares the hell out of everybody, but let's go here. Free cash flow for equity. Now, what is for free cash flow for firm? FCFF. What is my FCFF? Come on, give me the number.
Negative 8.5.
Negative 8.5. There you go. And then what I need to subtract? Interest times 1 minus t. How much I need to subtract?
15.
No, come on. You already calculated here. Interest times,
10.5.
not
Yeah.
interest times 1 minus t is 10.5, right? How much I subtract now? Come on, come on.
10.5. Is that
There you
you
go.
would subtract that amount?
Yeah, you already calculated negative 10.5. And plus how much I need to add?
134.
24.
Yeah.
134? No, 24 net borrow.
24.
Oh, right. Yeah.
So I got free cash flow for firm is 5. It could be 5 million or 5 billion. I don't care. That's what it is. So you got to remember this. We already calculated this number. We already calculated this number and we calculated this number. Man, this is so easy, easy peasy. So now you know how to calculate. I'll give some math problems, but um, for now, I'm giving you a chance to work on your project. By all means, the drop deadline time is Friday, 12 p.m. Those who are watching, please keep a note. Some of you have not submitted. If you miss this, you'll fail the class. And I want you to submit your midterm project by Friday, 12 p.m. With that said, you guys are so nice, and I'm glad you guys took time to come to the class. And those who are already scheduled conflict, whatever, please watch the video. And I'm also uploading this sheet. And so you can, this is, let's name it free cash flow. free cash analysis or calculations. And this one is, um, yeah, what do you call this? Scoring, whatever you call. This is what I'm going to upload this. And is it easy, guys? You're on the class, whoever looks, the formulas looks goofy and complex, but isn't it easy?
Yes.
Okay.
I think all formulas in accounting have been generally easy from my experience and ties into this.
Yeah, as long as you follow properly and that good. And yeah, you're right.
However, you do have to remember all the steps.
Yeah, I mean
Mhm.
that's the beauty of it, right? As long as you do this one time, one day you'll be an investor. One day you know how to do the math. You don't need to rely on Bloomberg. You are the Bloomberg. You are the man. You are
So
the one.
I have a question about this. How would you apply this math to your investing?
Yeah, I mean, I always get complex questions. But the thing is, it gives me rough ballpark number, and sometimes the numbers what you see, they're not always accurate, and irrespective either Reuters or Bloomberg, whatever. But the numbers what you could crunch, that gives you best and latest information before the market gets the data. So a lot of people rely on, let's say if the quarterly numbers came and you crunch these numbers and you get out of the numbers and your valuation, you value the company far ahead of the market. That's where you have the information edge. Understand? That's where. See, by the time quarterly results come, annual results come, markets they look for what's the how much increase in the earnings per share, but they don't look into the complex numbers like cash flow, free cash flow. So earnings means nothing. Earnings can be easily manipulated. The cash flow cannot be manipulated. That's where you make the difference. The purpose of this class is I want you to make more prudent and more better analysts, better than other guys. It's always information age. As long as you're one step ahead, your math is good. Simple example, I'll tell you. I followed one time one company. It's called Michael. It's a nickel company produced in Russia. This is all 2007. And I found that company in the rudimentary tool at Yahoo Finance. And the stock was trading at $7. My valuation was around $60. And I thought this is too good to be true. I put some money. And then it became $7, $10, $15, $20. $30, $40. And then the numbers came, quarterly numbers. That even better. My valuation was $180 based on my valuation. I was still trading at 50 and I loaded it up. And believe me or not, but the numbers came, but the time market realized it took them more than 1 week. In the meantime, 1 week I was riding the wave and the stock ended up around 180, $190. I bought at $7. I started buying. And then this Jim Cramer picked it up in 2008 or something before late 2007. He started making, oh, Soviet Russia, Lenin, this, I love beautiful communism, I love Russia and all that. I thought, man, this guy's making noise. These crowds come in and I got out of 180, but that stock went all the way to 200 odd. Then I was lucky. Putin went and nationalized that nickel firm. I was lucky, that's anytime you invest in autocrats ruling the country, you're always in danger. But I was lucky and took the ride from $7 to $180. So that's what, not necessarily you make all the time. Now in the information age, the computers and all the crunch, but even they have all the numbers, they don't come up with the numbers as quick as you can, as you could. That's where information is. And sometimes markets ignore, they don't do the cash flow analysis. They do simply oh, 9 out of 10 times, 100 out of 99 out of 100 times in the market, they all talk about nothing but price to earnings, price to book. Nobody talks about cash flow. Nobody talks about the working capital charges. They don't talk about the changes in the inventory. They don't talk about account payables and receivables. The sales could be high, but account receivables could be high too. That means they're not collecting. They pumped up the numbers. That's where you raise the red flag. The sales are growing and they're not growing, or sales are stagnant, then inventory is accumulating. That could be red flag. Those are the things I want you to figure it out. So that's where the cash flow statement analysis comes into the picture. So with that, I'll leave you guys alone. And if you have any other questions, throw it to me. I stop the recording, otherwise it gets too full. Recording. Hopefully I'm recording. Otherwise I'll be in trouble. Oh my gosh. Where is this recording?
It says it's recording.
Yeah, it's recording.
Check on the top right